Well, good morning, everyone. It's Monday, it's March 23rd, and as I always say, let's get into it right now. So, week ahead, volatility is going to be running amok this week again. There's no question about it. There's no doubt about it. Whether the market goes up or down, volatility right now on the S&P is 11 times, 9 to 11 times its daily range. If you look at the SPY, this is the SPY right here. This volatility before this little sell-off here, we were averaging about $2 a day. And for those of you who don't know what the SPY is, it's the ETF exchange traded fund that follows or mimics the S&P 500, the biggest index in the world and the biggest measure of overall stock market performance. If you look at the trading range, you'll see that it's about $2, $1.80, $2.50, roughly $2. Right here, and this is the chart, the yellow line, that's the volatility chart. As you can see here, it's about $17, $18. It was actually closer to about $20. So volatility is 10 times higher. No matter how you slice it and dice it, we're going to have volatility. If you intend to trade, I know this sounds illogical, but trust me on this. Reduce your position size by about 8 times. Because the volatility is 8 to 10 times greater right now, right? So you want to reduce your volatility, your exposure, by that amount. So if you have 100 shares, and if your volatility was $2, now that 100 shares fluctuates $2,000. So you definitely want to lower your exposure by reducing your position size. That's the only way you could trade apples to apples in this volatility, the same way you trade it right here. Otherwise, your risk is going to be too great, and that's very important. Always measure your volatility and adjust your position size per risk. Now, let's talk about the week ahead. We're going to have a busy week. We got Redbook tomorrow. We got PMI Composite Flash. The big news comes out towards the second part of the week. As usual, we got durable goods. But Thursday's the big numbers. We got GDP, international trade in goods, and jobless claims. And finally, these numbers, remember, there's a lag between the time we get these reports and the time we find out what's happening. So these reports should take into account the beginning portion of the coronavirus and begin pricing them into its value. So you will see some volatility, especially towards the second part of the week, especially with the GDP, with the jobless claims, because there's no way they're going to be on par with the past. It's just not going to happen. The report that I'm really curious about is the consumer sentiment, because this consumer sentiment should take into account most of the negativity in the coronavirus, or at least 75% of the negativity. And I'm really interested in seeing how it's going to go. We just had a major announcement from the Fed about half an hour ago. Fed says we're gonna open up our wallets, and $300 billion is gonna go to businesses. Let's talk about it right now. U.S. Federal Reserve will lend to small and large businesses and local governments, as well as extend its bond buying program. Folks, this is called quantitative easing, extending its bond buying program, and that's how U.S. survived and prospered after 2008. Markets reversed sharply after the announcement. The Dow Jones swung more than 1,000 points from about 500 down to roughly 500 up. The yield on the 10-year Treasury also fell, all right? A sign that more investors are willing to purchase the securities. That's very important, all right? Fed also said it will set up 3 new lending facilities that will provide up to $300 billion by purchasing corporate bonds, buying a wide range of municipal bonds, and purchased asset-backed securities. That's huge, folks. $300 billion coming back into the market from the Fed is a lot of liquidity. It also says it'll buy an unlimited amount of treasury bonds and mortgage-backed securities in an effort to hold down interest rates and ensure those markets function smoothly. Folks, this right here is going to benefit the stock market, what I'm reading right now, for the next decade. This is a much larger amount than the Fed deployed in the financial crisis of 2008 and its aftermath. Oh yeah. In 2012, the Fed launched its third round of asset purchases, known as Quantitative Easing, which consisted of $45 billion of treasury purchases. So consider $45 billion versus unlimited. This is huge. I mean, really huge, and it's going to have a major impact on the stock market. If this doesn't, I honestly don't know what will. Looking at the stock market as a whole, I believe price is going to bottom out near this range. When price was around 240 or 24, let me do the Dow Jones. It's easier with the Dow. This is the DIA, it tracks the Dow Jones. You just have to remove a zero and then you'll have the Dow. When the Dow Jones was, let me go monthly here. When the Dow Jones was right around the 21,000, I said the market doesn't have a lot to go. It went all the way to 18,200 and it bounced back up. It's around 19,000, 19,500 right now. Pre-market, it's at 19,600. I don't believe we're literally at the bottom because I don't know where the bottom will be, but I don't think we're going to crash from this point on. In other words, there's a good chance we may go a little lower, a little higher, probably go up to the 200-day and bounce back down. But the odds are, 80% odds are that the worst is behind us. Why? NASDAQ 100 stocks, if you look at the momentum levels, we are now matching 2008 levels. And you could see here, even though we crashed, we went all the way to 4% of four stocks out of 100 in the NASDAQ 100 trading above the 200-day moving average. We went a little higher. We went to about 10%. Then we went down. I'm expecting the same thing here. I'm expecting this number to bounce a little lower, maybe a little higher, create a little V pattern like this. But it would not be out of the imagination to see us hover around this level for a few months, which means you don't need to be in a hurry to buy this market. I think we're going to see a little more shakeout around these levels, especially with the volatility index remaining. Look at this. I mean, this is, let me show you this. This is crazy. Remaining near historic highs. We're still near historic highs. Fear level is still really bad. We don't know how the shakeout is going to come. We don't know the news. We don't know if the news is going to get a lot worse before it gets better or if the worst is behind us. It's a moving target. We don't know what is going to happen, how it's going to impact the economy, which is why the Fed is taking such major steps. All right. There's downside. According to New York hospitals, they're running out of equipment. Hunt for medical gear to fight virus becomes all-consuming. New York says they got about 2 weeks left. All right. So there's a lot of issues with how we're going to deal with this virus with people who are infected. South Africa infections grow by 402 overnight. Air Canada lays off 5,000 workers, and school districts take unplanned plunge into online learning. It was going to happen sooner or later. So, folks, we are not out of it. The Fed is doing everything possible. Don't expect the market to all of a sudden just bounce back and pretend nothing happened. This is a major crippling. This coronavirus has a major crippling effect on major economies and sectors. And I'm going to be talking about that as the week continues, because a lot of sectors are going to go out of business. This is going to have an immense take on the retail industry, and retail makes up a huge percentage of the economy. There's going to be a lot more rotation from retail, brick and mortar stores. There's going to be a lot of bankruptcies, but at the same time, companies like Amazon are thriving. I know that Walmart is moving a lot of people from brick and mortar into their online division right now. But one thing I could tell you for sure, volatility is going to be here for a while. So folks, whether markets are up or down right now, I'm not surprised. In fact, I warned you this was going to happen. I did. I warned you that we were going to be all over the place. And I warned you several months back that things are going to get bad. All right? Not simply from the coronavirus perspective, from the perspective of the NASDAQ 100 having the highest momentum levels before cooling off. And we seeing that again. But again, I think the worst is behind us. Now, I've been trading for over a quarter of a century, 26 years to be exact. And I've seen a lot and lots of assets traded: stocks, gold, options, commodities, futures, currencies, bonds. I've seen everything under the sun, and I've traded everything under the sun. Now, that means I know for a fact there's always an opportunity, and I mean a big one. Stocks may be volatile, moving lower right now, But that's a small part of the trading universe. You've got currencies, you've got inverse ETFs, you've got shortings. I mean, you've got so many different ways to take advantage of this market in any kind of market cycle. The key is volatility. Now, that's why I've been urging anyone who's been listening to check out my jump trade alerts. There won't be one stock ticker in there. It trades currencies and gold. There are no stocks. There's zero correlation to the stock market. So I don't expect you to open up a Forex account, and I don't expect you to buy physical gold. You do all of this through ETFs. So I'm showing you how you could take advantage of markets that are moving like crazy right now, but don't have any direct correlation to the stock market. But you could trade these alongside Tesla, Microsoft, Intel. You don't need to open up a futures account. You don't need to open up a special Forex account. You could trade this in a regular stock brokerage account. Now, in the past 2 weeks, while the stock market's been going down, the jump trade strategy has delivered 103.6% return. Folks, I'm going to repeat that again. While the S&P lost 23%, jump trade made 103.6% return. All in a few weeks. That's right, a few weeks. It's perfectly designed to take advantage of stock market's downside. If you guys ever saw the video, my original video, I explained how when stocks create a lot of volatility up or down, especially down, that creates opportunity for gold and currencies. But they're not that easy to trade, and a lot of traders, they need to understand leverage, rollovers. I've taken all that away. I've created a system that's not correlated to the stock market, but you could trade just like any other stock. I've done that, and I told you a few weeks ago that this system is going to start really moving it, and it is. Down 23% in the S&P 500, up 103.6% on jump trade alerts. Folks, check out jump trades now. This is your ticket to surviving this volatility. All right, I'm not kidding you. Again, the stock market is not everything. You've got commodities, futures, Forex. There's a lot of ways to skin a cat. And I mean a lot of ways to skin a cat. Bond market, futures, options. Stocks are not everything. They're not the answer to everything. I've created this system to help you get over the current downside in the stock market and taking advantage with its volatility by completely avoiding it. Learn how to trade different type of assets in the same broker. Folks, it can be life-changing. This will give you a huge unfair advantage. Again, check out jump trade. Don't go 23% negative. Go for 103.6% positive return in the last 2 weeks. Again, you don't have to open up a gold account. You don't have to open up a Forex account. You could trade this with your stockbroker. Folks, follow the link below. Learn all about jump trades right now. Do yourself a favor. I've been dead on these last few months. I mean, I've been spot on. All right. People have been calling me Nostradamus. I love that. Roger Nostradamus. Anyway, folks, check out jump trades. With the volatility continuing, and folks, it's not going anywhere, you want to have an unfair advantage, jump trade will give you that. Follow the link below. Do it now. Talk soon.